If you go out in the market searching for a forex trading strategy, they all will tell you that win rate is the most important part. And this is why the whole market is selling their strategy based on win rate. Like 80% win rate, 90% win rate, and I have seen people claiming 100% win rate of their strategy. Keep this thing in mind. No strategy in the world can claim 100% win rate. And on the other hand, win rate cannot even tell you 20% about the strategy. It is just like judging a car based on its top speed. We cannot judge a car just based on one factor. There are a lot of important factors like mileage, safety, comfort, etc. In the same way, there are other factors too which you should consider before choosing or buying a forex trading strategy. Like the risk to reward. How much you have to risk on each trade and how much is the potential reward. A number of setups or trade opportunities. How many setups or trade opportunities can we get from that strategy? Do you wait for weeks to get one? Or can we get multiple opportunities in a day? And which type of trading strategy it is? Does it have proper rules for entering a trade and rules for taking profit at the optimum time? After all these questions are answered, then only you can evaluate and select a strategy. But that's not it. There is one more thing that makes a strategy complete. That is the trade management plan. No matter how perfect your trading strategy is, or it does not matter how much knowledge you have about forex trading, you won't succeed in forex until and unless you have a solid trading plan. A solid trading plan is like a navigation system for you. It helps you stick to your path of profit and makes sure that you are not moving in the wrong direction. So the better your trading plan, the better will be your chances to succeed in forex. Keeping all these factors in mind, I have created a forex profit system which is based on swing trading style. This strategy which I have taught in the system is the exact strategy that I use to grow my account. This swing strategy has 70% of win rate, 1:4 to 1:6 risk to reward ratio. It provides multiple setups each day. It also has rules to enter and exit a trade. And in this class, I will teach you how the forex market works and why does it moves, how does the forex market moves, and what does it tells us, what is support and resistance, how to draw support and resistance correctly. This is very important because 80% of people identify support and resistance in a very wrong manner. The next is how to identify proper divergence, my secret trading strategy, risk management plan for this specific strategies, and some examples. But that's not it. For a very limited time, I am going to give away my trade management plan for this exact strategy. This is not just a normal trade management plan. This trade management plan consists of a simple system that will help you make 2 times profit in each trade. This secret is very powerful and will help you achieve your trading goals in half time. This system of trade management plan will take your trading to the next level. But remember, this is for a very limited time. So without wasting any time, let's get started. Have you ever wondered why does the price of currency changes? Or what are the factors that affect the price of the currency pair? In this video, I will explain to you the exact mechanism of the forex market. As you know, before someone becomes a doctor, he or she has to understand how the human body works so that they can learn how to treat their patients properly. And in the same way, we need to understand how does the forex market works so that you can use your strategy to make profit. You have to understand why and how does the forex market works. Forex market is a continuously moving market. There is a lot of change in the value of different currencies of the world. So what causes the value of the currency to change? Basically, 3 factors affect the Forex market? The traders, the banks, and the fundamental news. Now, how do these factors affect the Forex market? The first one is the traders. There are basically three types of people who fall under this category: day traders, swing traders, and the position traders. Now, the traders basically react to supply and demand areas because they feel that this level is important. Now, what drives the Forex market is the volume. The party which has more volume drives the market in their direction. Let's say buyers are more in quantity than the sellers. Then the buyers will push the market up. The party which has more volume has the momentum of the market with them. So there are different levels of supply and demand which the traders react to. This causes the momentum to change from time to time throughout the Forex market and hence cause the price of the market to constantly change. Now, how do the banks affect the Forex market? The banks or the positional traders basically changes the main trend of the currency pair. They enter the market in very specific areas and drive the market their way. The third one is fundamental news. Now, every country has their economical data, and this data tells us that if the country's economy is getting stronger or weaker. Now, if the economy of the country gets weaker, then their currency gets weak. So, every country has the economical news scheduled throughout the month. When this news is released, it causes the short-term and sudden movement in the Forex market. We are day traders and swing traders. So, all we have to do is understand how the traders affect the price of the currency. This is because if we know what the other traders are thinking and what most of the traders will do at a particular stage, then it can help us to be on a winning side.
Hello and welcome back. In the previous video, I told you why the Forex market moves. And now in this video, we will learn how the Forex market moves. Now, you must be thinking why you should know this. Because this will help you understand the next move, volatility, and the direction of the market. Many a times you must have noticed and felt that everything has a pattern and everything works in a pattern. This thing is absolutely true with Forex. So, what is an impulse and what is an correction? Now, let us move to the Forex chart and understand what is an impulse. An impulse is a move made by the price which is strong in nature and is dominated by a single party, either buyer or a seller. In the more simpler terms, when the price covers a long distance in a very short time, then it is called as an impulse. If the price is in an impulsive mode, then you will see larger candles like we have over here. The candles are larger and you will mainly see only single types of candles. Like here the candle forming are all bearish candles. The black one are the bearish candles. Impulse tells us who is controlling the market. If the impulse is in the upward direction, then that means that the buyers are in control of the market. And if the impulse is in the downward direction, then that means that the sellers are in control of the market. You can see over here, from this point, the market started to move down. The candles forming over here are larger and there are mainly only one type of candles in this area. Those are the bearish candles. So this type of move is called an impulsive move, and this is telling us that at this area the sellers are dominating the market. So this is called as an impulse. Now let us see what is an correction. An correction is a move in which the price moves very slowly and the market is in indecision period. This means that both the buyers and the sellers are fighting to take over the control of the market. You can see at this area from this point there are mixed candles and the distance covered is very small. The price is moving horizontally. This tells us that right now both the buyers and sellers are fighting for the control over the market, and this move is called as a correction. Impulse tells us who is in control of the market based on the direction, and correction tells us that both the buyers and the sellers are fighting to take over the control of the market. Now that you have understood impulse and correction correctly, let's move forward and try to understand why is this important to us. It is important to understand the movement of Forex market because it helps us to enter in the market at the right movement. Because impulse gives you more risk to reward, and that too in very less amount of time. So I have developed few principles of impulse and correction which will help you to understand the market more correctly. Basically, there are three types of corrections which the price makes. One correction is in the horizontal direction of the previous price. The price sometimes makes correction in the horizontal direction. Sometimes the correction made by the price is in the opposite direction of the first impulse. I have developed few principles of impulse and correction which will help you understand the market more correctly. The first one is types of correction. Now consider this thing to be an impulse. So the correction made by the price can be in the opposite direction of the first impulse. It can be in the horizontal direction of the first impulse, and it can also be in the direction of the first impulse. So there are three types of correction which the price usually make. The second one is the impulse after correction is 60% times in the direction of the previous impulse, and this is called as continuation of the price. What this means is, consider this to be the first impulse and then price gave an correction. So 60% of the time the next impulse will always be in the direction of the first impulse. So here the first impulse was in the downward direction, so the second impulse will also be in the downward direction. We have one example over here. You can see this was our first impulse and this was our correction. So the impulse which the price made after the correction was in the direction of the previous impulse, which is downward direction. Now the third principle is sometimes the impulse is in the opposite direction of the first impulse, and it is called as a reversal. Consider this to be the first impulse and the price then gave a correction like this. So the next impulse can sometimes also be in the opposite direction of the first impulse. The first impulse was in the downward direction, but the second impulse was in the opposite direction of the first impulse. So when you see this type of pattern in the market, then it is called as a reversal. Now the fourth principle is correction on smaller time frame can be an impulse on higher time frame. Let me give you an example for this. Now you can see at this point the price created an impulse and then the price gave an correction, and this was the second impulse. So the correction on this chart can sometimes be impulse on the higher time frame. So if we move and check this area on the higher time frame, then you can see that the correction on the smaller time frame was an impulse on a higher time frame. I hope you understood this topic correctly because you will have to use this throughout the class. So if you think that you have missed out something, then you can go back and watch this video again and make sure that you make some notes. See you in the next class.